The Nasdaq is on course to set an all-time high Monday as Wall Street extends its rally. Joining us from Basalt, Colorado, is George Ball, CEO of SMH Group. George joined us last time, being cautious about the markets, and today he said he thinks that the market's next move could be likely south. Welcome back, George. So, what do you see that makes you think that the next big move by the market will be down?
Uh, of the self-proclaimed experts like me thought that the market's move, which has been dramatically to the upside, would have been at least modestly, if not dramatically, to the downside. The combination of COVID plus protests plus looting plus really very, very low earnings base for companies would logically argue for a lower market. However, the better employment numbers, the hope that springs eternal within the human breast have all combined with animal spirits to push markets sharply upward. There's a disconnect between what's happening right now and the direction of stock prices over the last 3 weeks. Everybody, though, has to remember one thing. You can't buy yesterday's prices. I'd like to. Tried. It's unfortunately not possible. You only buy tomorrow's prices. It doesn't matter what's happened recently, what's going to happen next. I think that the corporate earnings in 2021 are going to be much lower than anybody's predicting at this point. And lower earnings tend to coincide with lower multiples. Therefore, I think that recent history aside, the next move of the market is much more probably down than up.
And George, right now the S&P 500 is trading in roughly 22 times forward earnings. Well, how deep of a fall do you expect? Where do you see the S&P?
Well, Fred, I dislike saying this, but you could say a multiple of 15 times earnings of $150 next year. I think gets you to 2,250 on the S&P rather than 3,200. That's a big decline. Is that going to happen? Who knows? But that certainly is not a fundamentally based illogical worry.
Not illogical. Now, as you pointed out, we've seen a V-shaped recovery in stocks, but the outlook for the economy and earnings certainly aren't anywhere near where the peak levels for the stock market were in February, which is where it is right now. Is it okay historically for the outlook for the economy and earnings to be so out of sync with the markets?
No, Fred, no, it's not okay. It really isn't. The market tends to be a forward-looking beast. Some people say the market lacks morality right now. Well, that's not true. The market's looking forward 6 months to 9 months from now. Nobody knows what the new normal is going to be, but it's not going to be the old normal. Could be better, could be worse. It's more probably, in terms of earnings, a more subdued uh, uh, backdrop than we've seen for the last 4 or 5 years. That's why I would be more worried about the markets than hopeful. What's next for the S&P? Is it 4,200 or is it 2,200? That's the big money bet. It's not the day traders bet; it's investors bet.
And lastly, George, from your note, I take it that you're in favor of small cap stocks at this juncture. Why, for example, would you prefer the prospects for an Elanco in animal health versus, say, a big cap like Zoetis?
Uh, Elanco or some other small cap stocks have two advantages. A, they're cheaper as public market companies than they would be as private market companies. B, they're special situations. And to me, equity investment right now is finding something that's so damn cheap. You just have to own it no matter what. And it can float upward even if the market does not. I will say that I think that the fangs or the FAMs, if you want to use that phrase, are dramatically overextended at this point, and that they're great companies. They have a lot of cash. They're growing, but they may be at bubble prices right now.
All right. I'll take that warning. Thanks a lot, George. Appreciate it.
Thank you, Fred. Good to talk to you.
Good having you on. Our thanks to George Ball of SMH Group. I'm Fred Katayama in New York. This is Reuters.